Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, aka Mr. Valuation. With today's video, I'm going to take a look at Cisco, and I'm going to title this video Cisco Lessons in Valuation, because I think what's happening today is really very interesting, and I believe it speaks loudly to the importance of valuation and the importance of fundamentals and the importance of focusing on fundamentals when you're evaluating your stocks or your investments. You know, like I always say, measuring performance without simultaneously measuring valuation is a job half done. And that means you want to also calibrate your performance based on valuation. If a stock is performing poorly, but it's undervalued, you might give it a little bit of slack, where if you've got a stock that's doing great for you, but it's way overvalued, you should be somewhat cautious. And what's happened today with Cisco just really kind of brought up, I felt some really good lessons or potentials to showcase how important valuation is. So let's go ahead and look at Cisco Systems, obviously the tech giant. And, a couple things I want to point out. I'm looking at this stock going back to the 2001 recession. And if you look at Cisco over this time frame, I want you to see that the company grew earnings pretty consistently at a double-digit rate, about 10.28%. Now, prior to the year 2011, this was purely a growth stock, and you could see it had some pretty high growth numbers back here, in 03, and their fiscal year ends in July, by the way, so they had a 32% earnings growth, 50%, 21.9, 24, etc. And if you look at the stock over this time frame, and this is kind of the importance of valuation, you will see that the market had it valued at pretty high valuations back there, but it also had a pretty good stint of growth during that period of time as well. But then eventually, as we kind of move our eye further down the line, the growth rates began to slow down clearly. We still had occasionally a double-digit growth rate, but then in 2011 it was 1%, then 14.9, then 2, 7, 7, 1, 9, 19, 4, etc. So we're getting a much lower rate of growth. So if I shorten this time frame, we're now down to a 7% growth rate that's gone from a 10% growth rate. But again, I'm going to use my scroll bar function here, and we had 20% growth, going from the period 01 up through 2007 here. We had over 20% growth. So companies morph and companies change. And what really happens to a lot of growth stocks like Cisco is they begin paying dividends, and all of a sudden they then become good dividend growth stocks. And if I look at Cisco over the time that it's paid a dividend, it's increased its dividend at a very high rate. But again, I want you to note that initially, when a company first starts paying a dividend, a growth stock like this, they end up increasing their dividend a lot, and then they kind of average that out over time. Okay, so that changes over time. But here's what's very interesting. If I look at Cisco today, yesterday's close, the stock was almost $57 a share. All right, and then they had an earnings announcement, and they gave some rather weak revenue guidance. And at one point, the stock was down 10% and trading at around $51 a share. And that would bring it to its intrinsic value by next July, based on the earnings of the company as depicted by FastGraph with the fundamental value reference line, a PE of 15. Note that that's almost precisely a 9.6% drop. If I get a quote on Cisco currently, right now, you'll see that the stock is down over 8%, trading around 52. It was down at one time, all the way down to 51.20, which you see right here. That was at 10.21. So the reality of it is, this is a correction where the stock has now come back into fair value. It doesn't have a margin of safety yet, but the price as of tomorrow's close will be sitting pretty close to this orange line, depending on what happens between now and the time that the market closes. But I want to say something interesting about this. This is really a great stock that offers a lot of great lessons in terms of how earnings drive market price. You can see, how when the Great Recession came, the stock got undervalued, and then it's been pretty much tracking earnings. Now, interestingly enough, back in November of 2019, I did a video on Cisco, and this is close to that time. It's not perfect. This is October, but the stock price was around 45-ish. And let me go ahead and give you some insights. I'm going to go ahead and showcase some of that video here. This was the video I did, as you can see, on November 21st, 2019. Cisco was at $45.08. So as I look at the stock here and play the video of 2001 and held it into the throes of the recession in 2002, you'd have continued to lose money. All right, and you can see this drop here, and this is the old version of fast graphs. We're using monthly closing stock prices. Some other interesting factors to note, though. Earnings estimates were $324 for fiscal 20, $339 for fiscal 21, and then $354 for 722. Okay, so let's measure that now against where we are today. All right, today we have 20 came in at 321, and then 21 was 322, and of course this is COVID related. And then we've got estimates for this fiscal year, which ends July of 2022 at 342 and 367. So things have changed, but they haven't changed that much. But what happened today was the company gave revenue guidance of growth of about 4% or so. Now, what's interesting about that, if I go down to the sales graph here, the price to sales graph, and look at forecast for revenue growth, it's 4.28%. That's essentially the guidance that the company just gave in their, guidance that has really caused this 10% drop in price. All right, so it's really nothing's changing here. The only thing that's changing is the stock was about 10% overvalued prior to that guidance, and it's now moved into pretty decent, guidance. So I think Cisco is an interesting lesson in valuation. But I want to go back to this original video I did and also point something else out to you here that I think is real important. Look how overvalued. I don't go back far enough anymore. I've lost the ability. Look how crazy the valuation of Cisco was coming into 1999 and 2000, and how the price hasn't even gotten close to coming back to that level yet. This is a classic. This is the tech bubble, obviously, and a classic of how overvalued stocks can collapse. This stock fell almost 75% or 80% initially, and it really was a poor performer. And to this day, it is still not back to what it was, in 2000, in like June or July of 2000. So, valuation matters, and it matters a lot. There's something I, constantly am talking about. And right now, Cisco had been a stock that I had always liked. I do have some positions in Cisco. I wasn't buying it here. It has now come, roughly into near trading around 52. Intrinsic value would be 51. Depending on what happens over the next several weeks or months, I would say Cisco is starting to look like a very interesting stock again. And if I can buy it at those valuations, I've got a decent chance of making some, pretty good money if I can get it down here, at say $49 or $50 a share. Then Cisco would start to be, an investment that would be intriguing again. Valuation matters a lot. I'm very picky about valuation. In other words, I love Cisco anytime during this period. I did the last video when it had fallen into fair value here. And, if you measure that, it was around $45 a share. I'm not going to be perfect here. Coming into today, it was giving me about an 11 or 12% rate of return. But now, looking at it as where it's going to end up here, that return is down to 6%, based on this correction. But the reality of it is, look at how it got undervalued and then reverted back, got undervalued, reverted back. The point is, I don't trust stock prices. I trust the orange line. And people don't believe me when I say this, but I often look at these graphs without the stock price even on the graph, because I want to own a business like this that has very consistent long-term growth like this, that has a very good dividend record that consistently increases its dividend. But the key point is, I don't want to overpay for it. So I want to buy it when the price is at or below this orange line as a metaphor, as a valuation reference, where I've got an earnings yield of 6.5% to 7% or better as a minimum, not my maximums. Anyway, I just thought it'd be interesting to showcase the fact that Cisco, with today's correction, has gone from being moderately overvalued to coming into fair value range and should start showing up on everybody's radar screen as a dividend paying stock, because, as of yesterday, it was a 2.61% dividend yield. As of today, where now it's down 8%, that dividend yield's up to about 2.84. and it'll be starting to approach 3%. You can buy Cisco with a 3% plus dividend yield. As a dividend growth investor, I think you should act on it. Anyway, this has been Chuck Carnevale saying thanks for watching. Hope you enjoyed this video. I just thought it gave me a great opportunity to point out some principles of valuation and show how valuation works. And even in the short run, valuation can be a big factor. But in the long run, if you buy great businesses at good valuations, you're going to do very well as an investor. And if you overpay, inevitably you're going to get hurt. You can, profit in the short run by doing that. But in the long run, you're probably not going to do so well. Stocks get value from the amount of cash flow they generate. And that's what this is all about. Trying to buy them when your earnings yield, your cash flow yields, or even your sales yields are high enough to compensate you for the risk you're taking. Thanks for watching. Give me a like if you enjoyed the video, thumbs up, ring the bell, subscribe to the channel, and take a look at Fast Graphs. By the way, as a preliminary announcement, and I've waited to the end of the video here to do this, we're looking for a December 5th launch of this new version of Fast Graphs. We're pretty firm on that. There's a possibility it might be delayed. We're actually ready to do it next week, but we feel like that being Thanksgiving weekend, we wanted to delay it for another week. So by December 5th, we should be launching this new version of Fast Graph with, some great enhancements on it, a lot better speed for those of you who are already subscribers. And you might want to take a quick look at it once that happens. Anyway, thanks for watching.